Hey traders, welcome back to another episode of TLA. First, on the 15-minute chart, we notice that price action is moving above the 50 EMA. The market is consistently forming new higher highs and higher lows, indicating a bullish trend within this time frame. So, our next step is to zoom in on the 1-minute chart to identify potential long setups. But before that, where should we ideally watch for trade opportunities? We observe that a recent area of market structure previously served as resistance. Following the breakout, that resistance has now flipped into support, potentially giving us a long opportunity. Now, we wait for price to enter our trading zone and monitor the 1-minute chart for signs of a reversal. Here, we can observe that the market has formed a double bottom pattern. So, we wait for a breakout above the neckline to validate the setup and initiate a long position. Scalping strategies in trading focus on executing fast, short-duration trades on volatile currency pairs by relying on technical indicators and strict risk control. However, it can be demanding, as traders must act quickly, and minor losses can build up if not handled properly. In today's video, we'll walk you through our methods for improving scalping performance. In addition, we're thrilled to present two top-tier price action setups and smart money scalping setups, both recognized for their high success rates. So guys, if that sounds valuable to you, make sure to tap the like button to show some love and subscribe to our channel if you're new here. We share a lot of advanced trading concepts. See you right after the intro and disclaimer. Let's start with the fundamentals. What exactly is scalping? The scalping approach consists of placing short-duration trades on lower time frames, typically during times of elevated market liquidity. So, what are the advantages and disadvantages of scalp trading? On one hand, scalpers might face a higher rate of false signals due to operating on lower time frames. Spread costs can also feel heavier than usual since they typically target around 10 to 20 pips. That's why having a strict risk management strategy and focusing on major currency pairs with minimal spreads is essential. On the other hand, scalpers aren't required to sit at the charts for long hours, as trade outcomes are often realized within the same hour. The overall results from scalping can be evaluated at the end of the trading day, taking into account both gains and losses. This method suits traders who prefer spending just a few hours a day monitoring the market. This is a list of key steps a scalper should go through before beginning chart analysis and executing trades. Now, let me break down two of the most effective scalping strategies based on price action scalping concept and smart money scalping concepts, along with all the rules. We'll begin with the price action scalping concept. This particular scalping method utilizes two time frames. The initial time frame is the 15-minute chart. We begin by using this chart to recognize the market's overall direction and decide whether to focus on buying or selling. Aligning with the dominant side of the market will immediately boost both our confidence and success rate. To assist with this, we use the exponential moving average by applying the EMA to the chart and setting it to a value of 50. In a bullish market, we want the price action to stay above the 50 EMA while forming consistent higher highs and higher lows. On the flip side, if the market is moving below the 50 EMA, we classify this as a bearish trend and will focus solely on taking short positions. If the price repeatedly crosses the 50 EMA in both directions without showing a clear trend, that's our signal to stay out of the market. Enhancing trade quality also involves recognizing when to avoid entering trades, which is just as vital as knowing when to execute them. Therefore, we must wait until a trend is clearly established before seeking trade opportunities. Now, the second step after determining market direction on the 15-minute chart is to highlight high-probability trading zones. Typically, we identify three major levels on the chart to serve as our preferred trading zones. Number 1 is the most recent market structure. In this case, the previous market structure represents the latest resistance level, which is likely to flip into support and drive the price upward. Number 2 is multiple rejections. A zone that has faced repeated rejections indicates that traders have reacted at this level on several occasions, which adds significance when the price approaches it again. Number 3 is a level that has served as both support and resistance. When a market structure level has historically acted as both, it raises the likelihood that the price will react to it again. After identifying these optimal trading zones on the chart, we wait for price action to reach those areas and then switch to the 1-minute chart to look for confirmation and entry signals. On the 1-minute chart, I'm watching for a particular reversal pattern known as a double bottom. A double bottom is an M-shaped formation that indicates a potential reversal. It suggests that sellers were unable to push the price below the market structure to form a new lower low. This setup is confirmed when the price breaks and closes above the neckline, and that's our signal to enter a long position. The stop loss will be placed just below the double bottom, and our target will be the next significant market structure level ahead of the price. But here's a crucial point. Sometimes entering the trade immediately after the neckline break results in a stop loss that's too wide. In such cases, we need to wait for a pullback to enter at a more favorable price. When this happens, we combine the double bottom formation with Fibonacci retracement levels. We use the retracement tool on the chart and place a buy order at the 0.618 retracement level. Again, the stop will be set below the swing low, and the target remains the next market structure level. Keep in mind, we can't predict where the move will end, so if price continues to climb, we'll keep updating the retracement tool using the latest leg. This process continues until price either retraces and fills our order or pushes through to hit our target, at which point we cancel the trade. Everything discussed also applies to bearish markets, so let's briefly summarize this plan in a bearish scenario. First, on the 15-minute chart, we need to see the price moving below the 50 EMA. This confirms a bearish direction, meaning we can start looking for short setups. Next, we highlight the most recent supply zone that could potentially reject price and drive it downward. Once the price reaches this area, we shift to the 1-minute chart to identify an entry for a short position. All we're looking for is a double top reversal pattern, signaling that the short-term bullish move is likely ending and price may continue lower. Now, let's look at some live chart examples to walk you through our thought process when a trading opportunity appears. Here on the Euro-Dollar 15-minute chart, we can observe that the price is trading beneath the 50 EMA. This indicates a prevailing downtrend, so our focus remains solely on short positions in this market. Now, the key question is, where should we be looking to enter sell trades? We recognize that this level previously acted as strong support. Following the breakout, that support has now turned into resistance, potentially presenting us with a trade setup. With our optimal trading zone identified, it's time to switch to the 1-minute time frame and wait for a confirmation signal. Here, we can see that the price has formed a valid double top, which acts as our reversal confirmation to enter a short position. Once the neckline is broken to the downside, we proceed to open the short trade, set the stop loss just above the double top, and aim for a target that is twice the size of our risk. Once again, on the 15-minute chart, we observe a clear uptrend, with the price trading above the 50 EMA, indicating a bullish bias. This means we are only interested in taking long trades. This significant level may act as a launch point, pushing the price further to the upside. So, we wait for the price to approach our zone and then drop to the 1-minute chart to seek confirmation and plan our entry. On the 1-minute chart, once again, the double bottom pattern gives us the signal to enter a long position. We wait for the price to close above the neckline to validate the setup, and then we take the long trade. Keep in mind, this trade follows a 1-to-2 risk to reward ratio, aiming to reach the next visible market structure ahead. However, if the neckline is significantly wide, it leads to a larger stop loss, and that's when we apply retracement levels for a more favorable entry point. Now here's the checklist tailored specifically for this price action trading approach. You can refer to this list every time you're about to execute a trade, whether on a demo or live account, to make sure you stick to the setup rules. This method is especially useful if you're just starting out or finding it tough to become consistently profitable. But always keep in mind, while a solid trading system can help grow your capital, a well-structured risk management strategy ensures you stay in the game. You can allocate 1-to 2% of your capital per trade and maintain no more than 3 active trades at once. That said, make sure to backtest this setup thoroughly on historical data before going live with real funds. Now, moving into the second part of this video, let's explore a more advanced smart money scalping concept. This setup focuses on entering trades through order blocks combined with a liquidity sweep, offering high-precision entries. Just like our previous price action strategy, this method also utilizes 2 time frames to increase the reliability of signals and improve overall trade execution. Step 1. Start by applying smart money market structure principles to the 15-minute chart to determine the overall market direction. This higher time frame analysis tells us whether we're looking for buy or sell opportunities. Once the trend is confirmed, we shift down to the 1-minute chart to identify a precise trade setup aligned with that direction. Imagine the market is in a clear uptrend, and the most recent move breaks structure to the upside, yet we notice no fair value gap, FVG, left behind in that impulse. However, upon scanning the left side of the chart, we identify a precisely formed FVG just below the previous swing low, which overlaps with a valid order block demand zone. This confluence suggests a high probability setup. The price is likely to dip below the swing low, trigger a liquidity sweep, and then reverse upward after tapping into the order block zone. In this scenario, we place a buy limit order just above the order block, accounting for spread. Our stop loss is placed below the swing low. Our target is the next significant market structure level in front of the price. This entry method combines two powerful smart money concepts, liquidity sweeps and order block reactions, to optimize entries with precision and risk control. In a bearish scenario, we observe a break of structure to the downside without any fair value gaps, FVG, left behind in the recent move. However, on closer inspection of the left side of the chart, we identify a precise FVG located above the recent swing high, aligned with a valid order block, forming a high probability supply zone. In this case, any change of character, CHO-CH, to the upside is not considered a genuine reversal but rather a liquidity grab. This move is designed to trap early buyers and collect stop losses above the swing high before resuming the primary bearish trend. Here's how we approach this setup. We place a sell limit order slightly below the supply zone, accounting for spread. Our stop loss goes above the swing high. Our target is the next significant demand level or structure low. This strategy effectively combines order blocks and liquidity sweeps, allowing us to enter trades with tighter risk and improved confidence in the direction of the smart money flow. On the GBP, 1 United States dollar minute chart, we observe a clear downtrend, with the market recently breaking a key structure level to the downside, which results in the formation of a fresh supply zone. Naturally, many retail traders are inclined to enter short positions if the price revisits this supply zone, leading to a concentration of liquidity above it in the form of stop losses and pending buy orders. However, if we shift our attention to the left side of the chart, we can clearly identify a clean fair value gap, FVG, situated within a well-defined order block. This area acts as a high-probability institutional supply zone. Smart money often exploits such scenarios, using the return to the upper supply zone to induce premature short entries, only to sweep the liquidity above, and then drive the price lower from the actual order block that aligns with the FVG. This setup exemplifies how institutions manipulate price around liquidity pools and inefficient price zones, giving us a strategic entry point when the market returns to the order block, not the obvious supply zone. We will place our sell limit order just below the order block, accounting for the spread, and set our stop loss just above the order block. Once the price moves in our favor and reaches 2 times our risk, we will close 50% of the position and move the stop loss to break even. Our final target will be the next significant structure level visible on the higher time frame, aligning with the market's directional bias. On the New Zealand dollar chart, we observe a strong downtrend with multiple bearish break of structure moves and no fair value gaps on the immediate right side. However, when analyzing the left side of the chart, we can identify a clean, unmitigated fair value gap positioned just above the most recent zone. The candle that caused this imbalance marks our valid order block. If the price pushes above this level, we will not interpret it as a valid change of character, but rather as a liquidity grab intended to trap early buyers. We'll place our sell limit order at the order block, following the same trade management rules. Stop loss, just above the order block. Entry, a spread below the order block. Target, the next significant level based on higher time frame structure. Risk management, secure the trade by moving to break even and closing partial profits once the price reaches 2R. Important note, trading with live capital involves real psychological pressure that paper trading or backtesting doesn't simulate. The real differentiator in consistent success is strictly following your trading plan. This is your blueprint for longevity and profitability in the markets. Alright traders, I hope you found value in this video. If you did, go ahead and smash that like button to show some love and support. And if you're new to the channel, don't forget to subscribe so you never miss an update. Catch you in the next episode. Stay sharp and trade smart.